No news, no trade, period. Today we're going to be going over the types of news headlines and articles that are acceptable to trade. Okay, you can't just jump into any stock for whatever random reason you have thinking that you're going to make money on it, because that's not a predictable or repeatable strategy. Okay, so today I'm going to give you the catalyst that I trade all the time, pretty much must be required in order for me to take a trade. So right off the bat here, I'm going to go ahead and give you guys a little box here that you can, use your little snip tool or whatever, take a screenshot, cut it up, crop it, put it on your wall. And next time you're looking at a stock to trade, if it doesn't have one of these news catalysts, then no trade. No news, no trade, period. All right, so right here is the catalyst that I'm going to be going over. These are the catalysts that I look for every time. I don't trade anything really other than this. Sometimes, very rarely, I'll take some random trade, but it doesn't usually work out. Usually just reinforces me, stick to your strategy because it works. All right, so again, take a screenshot, crop this up, print it, put it on your wall. It'll help you immensely. First up, earnings. Okay, each quarter, a company will release their earnings as well as a forecast for the upcoming quarter. This is typically called guidance. Okay, this will include many important key pieces of data. For example, a company may post a miss for the expected quarterly results. However, this could be less of a miss than the last quarter or the last year and may be viewed as a positive, especially if the forecast is positive, okay? So, for instance, let's say last quarter, this company showed a 60 cents per share loss. And this quarter, it's showing a minus 20 cents a share miss, right? Well, they still missed just like last quarter. Only this time, it was only 20 cents a share, not 60. That actually shows improvement. They're losing less money, so that's kind of on the right track, right? And now, if the forecast comes out saying they expect future quarter to be twice as good as the last, well, I mean, obviously this is positive news, even though it was a miss, okay? So you can't just take whatever earnings come out and say it's a miss and try to short it. It doesn't work that way, all right? So the key takeaways here is the nuances with earnings, okay, is pay attention to the last quarter, okay? Look at if it's a miss, look at how that compares to the last quarter. All right, and pay attention to the guidance. All right, the guidance is what matters. Just overall takeaway on earnings, listen to the guidance. All right. Now, my one rule here is I do not trade earnings pre-market or after hours. It's a total roll of the dice. Let the news get digested and trade the action thereafter. It's just too risky to try to jump in the pre-market or after hours with an earnings report, okay, when liquidity is so low. All right, go ahead and pull up some stocks and look at how they do in the pre-market or after hours with an earnings report. Okay, they get smacked like hard. And if you're if you're taking a position and all of a sudden you're trying to get out and there's nobody there to buy, oh man, you're gonna be deer in the headlights looking at your shit down like 15% in 10 seconds. All right. Now, number 2, analyst comments, upgrades, and downgrades. All right, this is a big one. All right, I used to think analyst ratings or comments was news for a stock, but I'll tell you right now, it is not news. It is not a big enough catalyst to trade. Now, there's 2 exceptions here. All right, the first exception is going to be when a handful of top-tier analysts all have a similar view or place an upgrade or downgrade with an increased price target of a stock. Okay, so if you're getting like 3, 4, 5 different analysts from like head banks, right? And they're all saying the same thing. They're all increasing to a buy. They're all increasing price targets. Okay, that's exception 1. All right, exception 2 is going to be when the stock receives a double downgrade or upgrade. So what this means is if a stock moves from a buy to a sell on the analyst rating, readout, that would be a double because it skipped the neutral or hold rating. Right? It just went straight to sell. Usually it goes from buy, neutral, or hold, then to sell. But instead, it went from buy to sell. That's a double downgrade. That's tradable. All right. 3, we got merger news. So this is news that two companies are uniting to form one company, typically to expand their reach and or to gain market share. All right. Headline risk is a big factor here and one that's really difficult to control. So what I mean by headline risk is say news comes out, boom, there's a merger between, Uber and DoorDash or something like that. And one of the companies comes out like, a minute later saying that's not true. Boom, stock straight down. Say you're long, you thought it was positive news and you just got whacked on it. Okay. That's called headline risk. You can't really control it. So, just be cautious in those. Now, there may be a trade opportunity if one company is merging with a much larger company, such as Amazon, Google, Apple, etc. So say like a smaller company all of a sudden gets picked up by Amazon, and Amazon wants to merge with them and kind of like, absorb them. Well, that's really good. That's really good for the smaller company. And because Amazon is such a huge name, that's going to really create some buzzwords. The ETFs, the algos, they're all going to jump on that. So that's a clean trade. You're allowed to trade that. All right. The next one is going to be acquisitions. All right. Acquisitions. Acquisitions tend to provide predictable trading opportunities due to the acquirer usually spending a large amount of cash or stock to complete the deal. Acquisitions result in the acquirer moving lower as they will be depleting resources to complete the transaction and is what ticker you will want to watch for a move lower in price. Okay, you're not going to want to watch the ticker of the stock being acquired. All right, that one is going to be pinned. So usually in the deal, you're going to see a price that this company is going to pay for this. Now, you're not going to want to try to trade the smaller one. You want to look at the bigger company that's actually burning cash up for a short or a fade trade. All right. It's usually a short-term fade. It doesn't last forever, but they are going to be burning cash and resources to acquire this company. All right. Now, a buyout, kind of similar to an acquisition. Now, the company that is being bought has an agreed upon price at which the transaction will occur, and the stock will then be pinned at that price, just like I said with the acquisition. Okay, the stock purchasing the other will often see a short-term decline in price, presenting a shorting opportunity. A trade opportunity often exists in the acquirer for a short, being that the acquirer will again be burning cash or leveraging up to close the transaction. Only trade the stock doing the buying. That's the takeaway. Offerings. Due to the various ways offerings can be structured, these trades are generally avoided altogether because of the lack of consistency in the resulting price action. All right, so offerings are when a company comes out and they need to raise cash, and the way that they decide to do it is they're just going to offer more shares of the same stock onto the open market, which is then going to create an increase in the size of the float. Now, when you do this, it kind of reduces the value of the other shares because now there's more out there. Does that make sense? Okay, so say a company has 100 million shares out there to trade. Well, that's going to give it a certain type of volatility and movement and value. Well, let's say they come out and they want to offer 50 million more, right? That's 50% of what's out there now. They're going to increase it by that. So all of a sudden, your stock is now going to move half as much as it normally would with the same buying pressure because the float is now increased by so much. All right. So offerings, they're structured really weird sometimes, unless you really want to dig into like the filing and read the actual, numbers and stuff on the, an S2, I believe, then, just stay away from it altogether. Right. I don't trade offerings. But they're a catalyst. The stock will move on it. Whether or not it continues to move, it all depends. Now, next up is going to be activist investor. All right. So famous activist investors such as Carl Icahn, Bill Ackman, Warren Buffett, George Soros, Daniel Loeb, right? These are all major market participants and normally will act as a very powerful catalyst. All right. These guys don't like to lose. All right, and they typically don't lose. All right, so an activist investor's goal typically is for the long term with a substantial upside return. thus why the stock will see an immediate and significant reaction to an activist investor headline, right? So an example headline would be Carl Icahn takes a 10% stake in XYZ, right? Well, that's huge. First of all, you got the buzzword Carl Icahn, you got the buzzword stake and a 10% number, which is a huge number. So all these little computer programs out there, HFTs, algos, they're all just going to jump on this and hit the buy button, right? That's typically what they're going to do. And you're going to try to follow that, right? But as a human trader, we only trade with managing our risk. We have a defined out. We have a low that we're working off of typically if you're trying to go long. So you don't just jump in like they do. You watch that happen and get in on a consolidation pattern and break, all right? So again, activist investor, you're looking for big names, percentage of stake in the company. These guys don't lose, all right? So next up here, we have FDA and clinical trial announcements. These type of announcements are extremely important to biotech stocks. The trial results are typically what the entire stock price revolves around, okay? If a trial fails or is rejected by the FDA, it can bring havoc to the stock, often slashing the stock price by 50% or more instantly, or vice versa. All right? These biotech stocks are typically only working on one or two projects at a time. So when one of these projects gets cut or canceled, right, it is very significant catalyst for a move in price. So say you have this company working on like a vaccine, right? They've been working on it for like a year and a half. They're at stage 2, right? And then all of a sudden the results from stage 2 get published and they're not good. The FDA rejects it and they have to cut the program. Well, the entire stock price of this biotech is going to revolve around what they were working on. And they're only working on one or two of these at any given time, right? So if they all of a sudden lose like their main profit driving idea, right, the stock price is dropping crazy. All right. And that's something that is tradable. So just, keep an eye out for those. Those are pretty good. And they typically are only revolving around, biotech stocks. Now, the next catalyst here we're going to talk about is a technical break. Okay, so a technical resolution on a stock can deliver extreme moves, especially if the technical setup is largely macro based, which means that on the daily chart, we're looking at lines that are greater than 6 months in length. All right, so you're looking like, say you have a triangle, you've got like 3 lows that you're connecting with a trend line, but those lows are coming from the last 3, 5, 10, 15 years, right? Those are macro based trend lines, and when these break, they give significant moves. Okay, significant moves. Now, the type of patterns that I'm talking about, right, usually will be a well-defined technical pattern. It'll be like a flag, a flat top or flat bottom, head and shoulders, triangles, etc., right? So the higher the profile of the stock, the more predictable the move. Now, by high profile, I mean Apple, Facebook, Tesla, Netflix, Amazon, Google, Nvidia, people you've heard of, people the stocks that have a lot of eyes, all right? People are watching these every day. They're very well tracked. They're very well reported on. All right, so generally, I won't trade the stock just because of the technical break, unless it has some sort of news to accompany that technical break. All right, or if it's one of the high-profile names, as there's so many eyes watching those on a daily basis. All right, so next up, IPOs. IPO trading is based strictly on price action and momentum, since there is no prior technical levels to work with, right? So if you see an IPO come out and you see it's got some crazy momentum to it, I'm talking volume, like extreme volume, right? This thing is ripping through points, not cents. It's going through dollars, right? Boom, $5, $10, $15, $20, right? These are tradable. Now, you don't want to just jump on every IPO, okay? That's not a predictable and repeatable situation. The IPOs that I like to look for are names that, for instance, Coinbase was one, right? Because crypto was huge at the time. They IPO'd at the height of the crypto run, the recent one. And ever since the IPO, they just went straight down. Okay. Another one I can think of is the Snapchat IPO, right? Well, we knew going into it that Snapchat had like an exorbitant amount of debt. Okay. They had a ton of debt. And when the IPO came out, that's going to cause sell pressure, meaning that the people that are already that bought into the IPO through the underwriters before it actually hit the market, they're going to want out. Right? They're like, dude, whoa, I don't know if I really want to be in this with this company, Snapchat. Like, they got so much debt, man. Maybe I can sell my shares at IPO date to the general public, like us, retail traders. And, it can cause momentum to the downside, stuff like that. You can also cause momentum to the upside if it's a really good one. But again, IPO trading is strictly based on price action and momentum of that day. There is no prior data to work with technically. All right, so next up, we have key management changes. So this one here is going to be a change in C-suite executives. They can have different effects on stock price, which will all depend on the scenario. For example, if a change to the CEO is unplanned, this is often perceived with more downside than upside due to the unknown component, of new management, because we don't really know who's going to be coming in. Why did this guy just get dropped? Did something happen? Like, is he getting sued for doing some, sexual assault stuff? I have no idea, right? But this is a big deal. We don't know what's going on. We don't know why that occurred. It was unplanned. So that's going to be looked at as a negative. Okay, so that's where you would want to be looking for a short situation. And the stock price will tell you this too. You can see, the movement of the price, right? Like, you're not going to see the CEO is, fired, unplanned, gone, and the price isn't going to be ripping up, right? Unless the company has been seeing poor earnings results for several quarters, or has made poor decisions over their term as executive. So say a new executive came in 2 years ago, and ever since then, this company's been unable to post positive earnings. They just keep losing more and more and more money. They're acquiring companies that aren't producing enough revenue for how much it costs. These are all bad decisions, and you can't really override the CEO. He was put there for a reason. But if he's not doing a good enough job, he's got to be replaced. And if investors are seeing that this guy just got booted, but then you look at, the earnings of the company and they've just been going down, 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 down. Well, sometimes this could be looked at as a positive, especially if the incoming CEO or any C-suite executive, CFO, CEO, whatever, CIO, if they're already part of the company, so if it's an internal move, this makes investors feel more comfortable, right? Because that person coming into the new position is already familiar with, how things work, why they go that way. They're already accustomed to the internal workings of the company, so it's not so scary. All right. So second to last one here I got is partnerships and contracts, etc. So these are really only relevant if you have a smaller company getting a contract with like a conglomerate. All right. So if the companies are of equal size, there isn't much of an opportunity there. One has to be huge and the other has to be a small or semi-small company for a major move to occur. So what you want to look for here is when you see a partnership or a contract, right? So I think recently, I wish I knew exactly what it was, but I think Amazon just contracted something to a smaller company, and that company ripped, right? I think also there was almost a contract through USPS and Workhorse, right? So USPS is a big name, right? And Workhorse was like a small, I think, what was it, hydrogen vehicles or something like that? And they were going to replace all their vehicles with theirs. Well, that's really good. That's a really good example of a big name partnering with a smaller name. Now, when that occurs, you want to look at the smaller name, right, for a trade, because that one is where all the speculation is going to occur on how much more their revenue is going to grow, their sales are going to increase, right, their balances are going to rise up. The contract is usually gonna carry like a giant dollar value of what the larger company is going to give them for this service that they're buying, right? So partnerships and contracts, key takeaway, small company to a big company. All right. So this last one I got here is SEC probes. And I'm including it because there's, it's a little iffy, right? Just because you see an SEC probe hit the wire or the headlines, it's not going to mean negativity right off the bat. And even if it does, that doesn't mean the price is going to move. All right. But sometimes this can be enough of a catalyst to move the price of a stock, right? But it's got to be extremely obvious. It has to be really, really bad, right? For the CEO, for the company as a whole, what they're looking into has to be pretty bad. And not only that, you don't just jump in. There's always going to be a process of a pre-trade checklist that you have to go through before getting into the stock. There's going to be a move. There's going to be volume. There's going to be the retest. There's going to be that little tiny consolidation pattern and then a break as you enter, right? You're still waiting for all that. You don't just jump right in, okay? But I have an example for an SEC probe would be recently, okay, Elon Musk and his brother, they were hit with one of these as his brother happened to sell $108 million of his Tesla stock, right? Just days before Elon comes online and sells billions of Tesla stock, really hammering the price down, right? Way lower. So did Elon tell his brother, hey, you should get out, man, sell your shares because I'm going to smack this thing over this next week and I don't want you to feel the pain? Did he do that, right? That's kind of like insider trading stuff that, is going to trigger an SEC probe. Now, is that negative enough to cause Tesla stock as a company to go down? Probably not, right? Because they'll just be fined. They're rich. They're not going to lose the company over this, right? Elon's like the richest man in the world. Of course he can afford it. All right. So SEC probes need to be analyzed on a trade-by-trade basis. Because of this, you'll have to sacrifice speed. I typically won't trade this type of news unless the price action and volume are really screaming the setup is present and the probe reads very bad for the overall company or CEO that's being probed. Okay. So that was a quick recap on the catalyst that I trade every day, the catalyst that I am interested in, and pretty much the only things that will trigger me to execute a buy or a sell, right? I hope you guys got some value out of that. I hope I clarified a little bit of what you're kind of looking for, what constitutes a decent catalyst and what doesn't. All right. And just remember, once again, no news, no trade, period. All right. That's a serious one. And don't trade earnings in pre-market or after hours. All right. Please, if you watch this far, I know you like the video, subscribe, thumbs up, comment down below on if you want me to do an in-depth thing on each one of these bullets. I can go pretty in-depth on what we're looking for, why it matters. This was just a quick rundown. Like, subscribe, please hit the bell if you're interested in more of this content. It lets me know you guys liked it, so I'll produce more. And stay disciplined.